0.2%.
That's the number Wall Street ignored on Friday while it screamed about 4.2. Headline inflation hit a 3-year high. Every desk called the Fed trapped, rate cuts dead, hikes coming. But strip out one line and the underlying pace of inflation didn't accelerate this week, it was cut in half. The consensus built next week's entire forecast on the wrong number, and I'll show you exactly where they went wrong.
Here's the strange part. The same week inflation printed a 3-year high, the S&P 500 didn't crash. It ended the week higher. Stocks clawed back, the Nasdaq recovered, and traders shrugged at a number that, on paper, should have been terrifying. When the market refuses to behave the way the headline says it should, that's not noise. That's a signal. And almost nobody on the financial news circuit is asking the obvious question, why? Let me set the board, because the framework is simple: supply, demand, and one variable everyone underweights. This week handed investors 3 data points that pull in opposite directions. A hot inflation print. A surprisingly strong jobs report. And a sudden burst of optimism about peace in the Middle East. Wall Street grabbed the scary one and built next week's entire forecast around it. That's the mistake. The other two matter more than they think, because the question heading into next week isn't whether the Fed holds rates. It will. The question is what story the data is really telling and whether the most confident call on the street is built on the wrong half of the evidence. By the end of this, I'll show you the exact number that gives the game away. First, let's hear the consensus in its own words. Walk into any trading desk this weekend and the script is identical. Headline CPI jumped to 4.2% year over year, up from 3.8% in April, the highest since April 2023. The annual rate has now pushed back above 4% for the first time in 3 years. To the consensus, that's game over. The disinflation story is dead, and the Fed has lost control of prices. Confident. Unanimous. And, I'd argue, lazy. The jobs data only hardened that view. May payrolls came in at 172,000, more than double the roughly 80,000 economists expected. A hot labor market on top of hot prices is the classic recipe for a central bank that hikes, not cuts. So the bond market moved. The 10-year Treasury yield pushed up toward 4.55% by Friday's close. Higher for longer became higher, full stop, in the consensus mind, and the betting markets agree. Traders now assign more than a 70% probability to at least one rate increase before the end of this year. Rate cut bets that were everywhere in the spring have been quietly buried. The narrative is clean, it fits the data, and it's repeated on every channel. When a story gets this tidy, this universal, I get nervous. Markets rarely pay you for agreeing with everyone else in the room. There's also a calendar argument the bears love. June is historically the worst month for stocks in a midterm election year. Add a Fed that can't cut, energy prices climbing, and yields rising, and the setup looks ugly. The consensus conclusion: next week the Fed sounds hawkish, the dot plot shifts higher, and risk assets take another leg down. It's a coherent story. And coherent stories are exactly the ones markets love to break, so that's the read going into next week. Inflation's back, the Fed is cornered, sell the rally. Nearly every strategist is leaning the same direction. But here's where it gets interesting, because when I actually pull apart this week's numbers, the data underneath the headline doesn't say what the headline says. Not even close. Let me show you the cracks. Start with that 4.2%. Where did it come from? Energy. Energy prices jumped 3.9% in a single month, and they're up roughly 23.5% over the past year. Strip out the gas pump and the heating bill, and the picture changes completely. The headline number isn't measuring an economy overheating. It's measuring a barrel of oil, and oil is moving for one very specific reason. That reason is the Strait of Hormuz. Tensions with Iran put a fear premium on crude, and that premium flowed straight into the inflation report. This is geopolitical inflation, not demand-driven inflation. And the two are opposites. Demand inflation means the economy is too hot and the Fed must cool it. A supply shock premium from a conflict fades the moment the conflict eases, and raising rates does nothing to fix it. The Fed knows this distinction cold. Now the buried number. Core inflation, which throws out food and energy, rose just 2.9% year over year, barely up from 2.8%. And month over month, core prices rose only 0.2%. The month before, that figure was 0.4%. So the underlying pace of inflation didn't accelerate this week. It cut in half. That is the single most important data point of the week, and it got almost zero airtime. Here's another crack the consensus skips. That strong jobs number? Look at what bond traders actually did right after the inflation release. The 2-year Treasury yield, the maturity most sensitive to Fed policy, fell 2 basis points to 4.11%. It didn't spike. When a hot inflation report drops and the policy-sensitive yield falls, the smart money is telling you it read the same thing I just did. The core is cooling, the headline is noise. And the biggest crack of all, the thing that could pull the rug out from the entire inflation scare. The oil premium that drove this report exists because the market is pricing in conflict. But this week, stocks rallied on the opposite bet, that a peace deal is close, that sanctions on Iranian oil could lift, and that the Strait of Hormuz reopens. If that happens, oil falls, and next month's scary headline melts. Wall Street is short the wrong scenario, so here's my read on next week, the one the consensus is set up to get wrong. Wednesday, June 17th, the Federal Reserve announces its decision. Yes, they'll hold. Rates stay at 3.5 to 3.75%. Markets put that at over 99%. But the rate decision is the boring part. It's already priced. The real event isn't whether they move. It's what they reveal alongside it. This is what almost nobody is emphasizing. Next week is a projection meeting. The Fed releases an updated dot plot, every official's forecast for where rates go from here. That chart, not the hold, is what moves markets. If the dots stay stable, the door to a later cut stays open, and the whole hikes are coming trade unravels in an afternoon. The consensus is bracing for the decision. The smart money is watching the chart, and there's a wild card the street keeps underplaying. This is Kevin Warsh's first meeting as Fed chair. He was sworn in on May 22nd. A brand new chair, his first press conference, his first chance to set a tone. Nobody, not one strategist, can actually predict how he'll frame this. The market is pretending it knows the voice of a man it has never heard run a meeting. That's not a forecast. That's a guess wearing a suit. Put it together and the contrarian setup is clear. The consensus expects a hawkish shock, higher dots, a stern chair, yields up, stocks down. But the data underneath argues the opposite. Core inflation is decelerating. The headline is an oil mirage tied to a conflict the market thinks is ending. The 2-year yield is already drifting lower. If the dot plot holds and the tone sounds balanced, the pain trade isn't down. It's a relief rally that catches everyone leaning the wrong way. Wait, it gets sharper, because the asymmetry is the whole point. If the Fed confirms the scary story, stocks were already positioned for it, so the downside is limited. But if the Fed signals patience, if it separates energy noise from the underlying trend the way the data does, the upside surprise is large, precisely because so few are positioned for it. Lopsided risk like that is what professional money lives for. The crowd is staring at the wrong screen, so what do you actually do with this? First, separate the two inflations. Track core month over month, not the headline. If next month's core stays near 0.2, the inflation scare is officially a head fake, no matter what oil does. The headline grabs attention, the core pays the bills. Anchor your read to the number that actually reflects demand, and most of the panic on your screen simply stops mattering. Second, watch oil in the Strait of Hormuz more closely than the Fed statement. Energy is the swing factor in this entire setup. A peace deal that reopens that shipping lane does more to kill inflation than any rate hike could. And third, don't trade the rate decision, trade the dot plot and the tone. The hold is priced. The projections and the chair's first words are where the real money will be made or lost Wednesday afternoon. Now, the number I promised you at the start, the one buried inside this week's report that flips the story. It wasn't the 4.2% everyone screamed about. It was 0.2%, core monthly inflation, cut in half from the month before, while the world stared at an energy spike from a conflict that may be ending. That's the decision Wall Street made this week, to trust the loud number over the quiet one. Next week, we find out if the Fed makes the same mistake. I don't think it will. The real question is whether you're positioned before everyone else figures it out. Thanks for sticking through to the end. Your support means the world. Like, share, subscribe, 3 quick taps.